Good afternoon and welcome to the Economic Center's annual luncheon. You may have looked at your program and wondered why the sequence of events is a little unusual, or you may have looked down at your table and wondered why you have no food at your place. The reason is we're accommodating our keynote who has to leave at 12:30. So to introduce our speaker, I'd like to turn it over to Sean Kelly. Sean is the managing partner of Northwestern Mutual Insurance here in town, and he's also the presenting sponsor of our luncheon today. He's on our board of trustees and was co-chair of the luncheon committee. So he provides outstanding leadership to not only Northwestern, but also to the Economic Center. So Sean?
Thank you. Well, I will be quick due to time, and on behalf of Northwestern Mutual, we are excited to see so many people here. I think this is our largest lunch to date. And a few years back, there was an article written in the Inquirer by George Vredveld, who used to be our then director, and he talked about financial literacy and financial education, and it's something I am very, very passionate about. I believe the more people that are educated about financial literacy, the better decisions they make, the more financially independent they become, and they become self-reliant. And when they're self-reliant, there's an interesting paradox in that those people tend to give back to our city and to our communities more so. And so the more we can teach people about financial literacy, the better, and that's what this center does. As a trustee of this center, I'd like to thank you all for the support of this organization, and I want to introduce our keynote speaker. He's quoted in just about every national and global publication. He's been interviewed by all the major media outlets. He's been a guest on CNBC. He's frequently on Meet the Press, NPR, and CNN. And he's one of the most respected professionals inside his field. Mark M. Zandi is the Director of Economic Research at Moody's. He's the Chief Economist for Moody's Analytics and is the leading provider of economic research, data, and analytical tools. He's also the co-founder of Economy.com. His broad research interest encompasses macroeconomics, financial markets, and public policy. His recent research is focused on the mortgage finance reform and the determinants of mortgage foreclosure and personal bankruptcy. As a trusted advisor to policymakers and influential source of economic analysis for business, journalists, and the public, he frequently testifies before Congress on topics including the economic outlook, the nation's fiscal challenges, the merits of fiscal stimulus, financial regulatory reform, and the foreclosure mitigation. He's the author of Paying the Price and Financial Shock. He's a graduate of the Wharton School and has earned his PhD from the University of Pennsylvania. Mark, we're very excited to hear about you and your take on this year being the breakout year for the U.S. economy. So please join me in welcoming Dr. Mark Zandi.
Thank you for that very kind introduction. Julie, thanks for the opportunity. Nan, it's good to see you. Financial literacy is a very important thing, and I think you can argue that one of the reasons for the Great Recession is a lack of financial literacy. So it's key that we help our children understand this a little bit better. When I was in high school, I learned how to make a pretty good omelet. Still can make a pretty good omelet, I think. But I didn't even know what a mortgage was when I got out of high school, believe it or not. I don't know, does that make any sense at all? I'm not really sure. Clearly it didn't, and I think you guys do great work, and very, very important. I really do want to thank Julie, though, for giving me 2 hours to speak. That was really kind of her. I can speak for 3 days or 3 hours or 3 minutes. How about if I go on for about 15, 20 minutes, because I'm between, well, your lunch is out there somewhere, so it can't take too long. I'm optimistic. I'm optimistic about the economy's prospects. Let me just give you a few numbers to make it concrete. GDP, that's the value of all the things that we produce. That's been growing about 2%-ish since the recovery began. Believe it or not, the economic recovery is now almost 5 years old, coming on 5 years of 2%-ish growth. We got 2% last year. This year, starting off a bit on the soft side. I don't know how the weather's been here in Cincinnati, but, oh, it's that bad, huh? Yeah, yeah. It's nothing compared to Philadelphia, my hometown. I lost power for 5 days, and fortunately I have a generator. You want to take a guess how much it cost me to fill that generator up with propane? $3,000, yeah. 500-gallon tank. I used every bit of the 500 gallons. So it's been a tough start to the year, I think, because of weather. We'll see a pickup in the spring. I expect 3%-ish growth in 2014, 4% growth in 2015, 4% growth. That means more jobs. We created 2.25 million jobs last year. We'll create 2.5 million this and about 3 million next year, and that means lower unemployment. The unemployment rate is 6.7%. Just for context, we hit 10% on the nose back in the wake of the recession in '09. If you told me we got back to full employment, which is an unemployment rate around 5.5% by late 2016, that kind of sounds about right to me. To be precise, November 4th, 2016. I'm not joking. It's probably 2 p.m. Eastern, too. Okay, well, why the optimism? Let me give you a couple, 3 reasons. And you should soak this in. I don't have a whole lot of time, but soak it in because I'm going to take a little bit of it back. Try to end on a high note. Reason number 1, this is about as close as it gets to arithmetic in economic forecasting, and that is fiscal austerity is fading. So we have been digesting some very significant tax increases and government spending cuts. Remember the sequester, that hit in full force last year. That's been a drag on growth, 2011, 12. Last year, the fiscal austerity cut 1.5 percentage points from GDP growth. So we grew 2. If fiscal policy was simply neutral with respect to the economy, we would have grown 3.5%, which, you know, most times would be considered pretty good. In fact, that 3.5% is a pretty good estimate of the growth rate in the private economy outside of government. Under current law, if lawmakers, Congress, administration do nothing, and I assure you they will do nothing, not this year, probably not next, the fiscal drag fades to 0.4%. Next year, it's a couple tenths. In 2016, it's 0. So this very, very significant headwind to economic growth, it's fading. It's fading. I'm not arguing that we've solved our fiscal problems. We've got significant problems, longer run, and we're going to have to address them. So we're going to have to take another big crack at this at some point. All I'm arguing is that we've done enough, the minimum amount we needed to do to stabilize the fiscal situation, get the deficit low enough that the nation's debt to GDP ratio, which is key to fiscal sustainability, stabilizes. At least under reasonable economic assumptions, that's the case. And they're reasonable because they're my economic assumptions. So we haven't solved our problems, certainly not longer run, but we have adequately addressed them, and we can still get my optimistic world outlook for the next couple, 3 years. Reason number 2 for optimism, housing. This is key. The housing market has made a bit of a comeback. Just to give you another set of numbers, we put up 500,000 homes in 2009, single family, multifamily. If you throw in manufactured housing, it's 550,000 units. Just for context, that's the lowest level of residential construction since prior to World War II. That's how low it got. We're at 900K in 2013, so we went from 500 to 900K in 2013. So that's improvement, we're moving in the right direction. In a typical economy, we should be putting up 1.7 million homes, 1.7 million. That's 1.15 million households, they form every year, and they have to live somewhere. And in fact, you could argue there's going to be a period when we're going to be above 1.15 million. There's a boatload of 20-somethings that couldn't get work. It's been pretty tough for them. and they doubled up with their parents. In fact, if you look at data from the Bureau of Census, there's probably 1.5 million more 20-somethings living with parents today than prior to the recession, and those households will form. I can attest to this personally. Yeah, I have a boy just graduated. Well, he actually graduated last May from Wake Forest University, philosophy major. Yeah, right. He's unemployed. Yeah. We couldn't find work. Here we are, what is this, March 2014, right? We're a year in, almost a year in. I'm sure I could have called up a buddy. I could have called up Nan and said, hey, Nan, my son needs a job. And Nan says, well, I can't really help you, but I know someone who can. But I figured that's not the right thing to do. He had to get his job on his own. This is going to be very important for him long run. I'll have to tell you, my wife has given me a boatload of grief about this. The pressure was intensifying every day. We had good news in the Zandi household a couple of weeks ago. He got a job. That's right. Real estate development, actually. I think it's perfect for him. I won't go into the reasons why. But you're asking, what's the point of the story? The point is, about an hour after he got the job, he's looking for an apartment, right? Yeah. So these households are going to break apart. So we're going to get a boatload of households formed over the next, I'm sorry, I used that word boatload too many times. I will not use it again. I've used it 3 times. I have a penchant for doing that. A lot of households over the next several years. 350K in obsolescence. Hurricanes, tornadoes, earthquakes. What kind of plague do you have here in Cincinnati? Tornadoes, yeah. And just normal obsolescence. And then second vacation homes. High-income households are doing fabulously well, no problem. Stock market's up. Many are in their 50s. They're looking for second vacation homes. You add it all up, it's 1.7 million. We're going to go from 900K in construction to 1.7 million. That's a lot of jobs. Every single family home we put up creates 4 jobs over a period of a year. Construction, manufacturing, transportation, trucking, financial services, retailing, Home Depot, Lowe's, home improvement, landscaping, cable hookup, it goes on and on and on. So just do the mental math. This is now financial literacy. So 900K, 1.7 million, multiply by, say, 3, because multifamily doesn't create as many jobs. That's a lot of jobs. It's a lot of jobs. And it's in mostly every community across the country. So this is something that's going to benefit, lift activity everywhere across the country. So housing's key to the economic recovery. I think it's going to continue to improve. It has to, if we're going to get to my 4% growth in 2015. How are you feeling? One more reason for optimism. And as I said, you better soak this in. This is more fundamental. The other 2 factors I gave, 2 reasons for optimism, are more, I'd call them cyclical. They provide juice to growth for a period of time, not over the long haul. The fundamental reason for optimism is that we've come a long way to righting the wrongs that got us into the Great Recession. We have delevered, reduced debt. The balance sheet of the private sector is probably as good as I've ever seen it in the data that we have back to World War II. American companies, non-financial American companies, the Krogers of the world, the Procter & Gamble's of the world, are very, very competitive. Done a marvelous job of reining in their cost structure. So the best measure of competitiveness across the globe is unit labor cost. That's the labor compensation, relative to the productivity of the workers. Unit labor costs in the United States today are roughly where they were a decade ago. And in manufacturing, unit labor costs today are where they were 30 years ago. No other country on the planet has experienced that kind of performance. If you look at unit labor costs in Germany, Brazil, China, everywhere, unit labor costs have been moving higher. So American companies are primed for growth. And the energy story is unbelievable. If you look at the cost of natural gas, the cost of electricity in the United States, it's far and away lower here than anywhere else in the world, with a few exceptions in the Middle East. So my sense is that this is going to shine through, that because American companies are so competitive, we're going to be able to sell what we produce all across the world, and that's going to lift economic growth and jobs in the longer run. Now, I have to say, I have been a little disappointed about the pace of economic growth. I had anticipated that the better balance sheet would begin to shine through a little earlier. So I've been overly optimistic. So you might want to take that into consideration with regard to my forecast. You know, in every economic cycle, you get to a point in the cycle where business people say, you know, I can't continue to grow my earnings, profits. I can't maintain my stock price, the value of my company, by working to contain costs. I've done that. That's what I did during the recession. You know, I worked really hard. I can't to reduce my cost structure. That takes me only so far. If I'm going to grow and increase the value of my company, of the work I do, I'm going to have to look for revenue opportunity. I got to take a chance. I got to start a product line. I've got to expand in a different part of the country. I got to go global. And it's like business people are thinking about these things all the time. You know, it's like this is what you do. You think, think what can I do? But the problem has been that we haven't gotten, you know, when you start a product line and you expand your footprint, you know, you can do all the planning you want, but and you're very careful about it. But at the end of the day, it is kind of a leap of faith, right? That it's going to all work out. There's a kind of a field of dreams moment in the recovery when business people say, you know, I'm going to look for revenue opportunity. I'm going to take a chance. I'm going to look for that opportunity and take a risk. And we haven't just quite gotten there in this recovery. That we haven't had that field of dreams moment. And I think the problem has been Washington has really been a weight on risk taking in lots of different ways. You know, debating whether we should default on the Treasury debt, really? Should we be even talking about that? Shutting the government down, really? You know, that's pretty spooky to people. And, you know, we've gone through some pretty massive reforms, the financial regulatory reform, healthcare reform, and I'm not even here to debate the merits of that. I see good and bad in both those things. You know, frankly, how can you go through the worst financial crisis since the Great Depression and not try to reform the financial system? I mean, yes, we can debate what's in it, but not to take a crack at it, really? I mean, so I understand it. You know, healthcare reform, that was by choice. We didn't, you know, necessarily have to do that. But they clearly have added to the angst. And thus, I think business people have been reticent to take that chance and that risk. But, you know, here today, Washington's off the front pages. They're not going to be there. It's done, you know, at least for the next couple of years. And I don't think we're going to be talking about defaulting on the debt or shutting the government down for the foreseeable future. Washington is off the front pages. And even the reforms, the regulatory reform, the healthcare reform, you know, still more work to do, still more hand-wringing about that, but much less so than a year ago, particularly with regard to financial regulatory reform, and clearly a lot less a year from now and 2 years from now. I think we're really close to that field of dreams moment. And it takes one CEO in every industry to say, I'm going. And then every CEO in that industry will go, because the last thing you want to do in this environment is to lose market share. That would be death. So when's that going to happen? I'd say May 28th, you know. Yeah. That's my birthday, by the way. So we're pretty close. All right, I don't really want to dwell on the dark side or the downside, but I do have to talk about one cautionary note. And I should preface this by saying there are a lot of things we need to be nervous about. You know, what's going on in the Ukraine it's certainly a wild card. China's always reason to be a bit anxious. Europe, it's going to be a slog for them, and the risks are always there. But the risk I want to focus on and end with is the last thing we need to do to extricate ourselves from the recession, the effects of the recession, is normalize monetary policy. So interest rates are low, right? We have a 0 short-term interest rate. The 10-year Treasury bond is trading below 3%. That's too low. The Federal Reserve is still engaged in quantitative easing, tapering it, drawing down the tapering, but drawing down the QE, but the quantitative easing, but still has a way to go. Now, in my optimistic vision for the U.S., I expect that the Federal Reserve is going to be able to manage the increase in interest rates that are coming in a way that is consistent with the improvement in the job market. So as we create more jobs, unemployment comes down, interest rates rise, and the benefit of the better job market trumps the ill effects of the rising interest rates, and we get my forecast. And what that means is, say, take the 10-year Treasury bond, we're at 2 3/4 on the bond, say, end of this year, we're at 3 1/4, 3 1/2, end of next year, 4 1/4, 4 1/2, and by the time the economy slides into full employment, which is, as I said, late 2016, the long bond, the 10-year bond is somewhere close to its long-run equilibrium value, which is probably just south of 5% in that range. That's kind of the sort of my forecast and what I expect. But I do acknowledge that this is going to be tricky, that it's not going to be a straight line, and it's going to be very difficult for the Fed to pull this off. I think they have all the tools they need. They certainly have the will. They have the right person at the helm. So I think they're going to do it. That's my baseline outlook. But in my mind, that obviously is the key risks. Let me end by saying, there's a lot of things to worry about. There always is. Always something to worry about. The risks are they're evident. I will say, we're due for some good luck. Not that I'm counting on that, but we are due. But I'll have to say, scouring the landscape for things to worry about, the risks are just a lot less risky today than they've been in a long, long time. And in my view, that's a great reason to be optimistic. Thank you very much. It was a pleasure. Thank you.